Okay, let's go on to our problem 8.2 here. And just like I did for 8.1, I'm going to snip in a copy of the homework problem here. You all have this in your paper, packet essentially. But I'm going to get it from my electronic copy and then just have it available so we can review it together when we're doing the problem here. Okay, so on problem 8.2. So we've got this company, and on April 1st, we paid to purchase several assets from a company going out of business. The appraised value was 500,000. We purchased them for 400,000, and GAAP requires assets to be valued at cost. So the 400,000. So Tory Company calculated the proportion of each asset's appraised value relative to the total appraisal value relative to the total appraised value. That's a little weird sentence, but basically we're saying, okay, we got this some appraisal, some third party looked at these assets, said they were worth this much, but we paid this much, and so we allocated the 400,000 out to those assets based on the appraised percentage of value, essentially. A little bit confusing, but anyway, let's go with it. So then we use those proportions, like we said, to calculate these totals out. So here we've got, now I'm just going to put it in again, I like listing things out in Excel to help us see what's happening here. It's our totals and everything. So building, land improvements, and equipment. So we've got 208,000, 96,000. So this should all add up to the 400,000 that we paid. And let's see here. Let's add those up. And as you can see, you get the 400,000. So again, it was appraised at 500,000, but we only paid 400,000. But we used that appraisal, which broke down the value of the 500,000 to these different components of the purchase with the building, land improvements, and equipment. We just used the ratio of those to figure out the ratio of the 400,000. So 52% of the value was in the building, 24% in the land, 8% in the improvements, and in the equipment. And if we were trying to really show what this is talking about, basically, so here's an appraised value, and then we have actual paid. And essentially what we could do, let's say, paste that in. So here's what we would say. So if we take that 500,000 times each of those components, you would get those totals, which all add up to 500,000. And so we're saying, again, we got an appraisal done that said, here's the value of all these things, and then here's the portion of that $500,000 value broken out. But we said, okay, great, but we're only going to pay 400,000. The seller said, fine. For accounting purposes, you don't care about the appraised value. You recorded it, what was actually paid. But we could use these percentage breakdowns, and multiply that out by our total actual paid to basically figure out what these allocations are. So anyway, I just want to do that, make it a little more clear. Okay, so let's, I'm going to copy a lot of this that we had from our first problem. Let's see if that messes anything up. No, we're good there. Okay. Yes. Okay. So paste that in, kind of, highlight the columns. You can double click on the side of any one of those to sort of stretch it out to the right size. And yeah, let's figure it out from here. And delete this one just to get us a little more compact and in there. And okay, record the journal entry for the group purchase on April 1st. So we're gonna have to do some journal entries, a little different than extra step, I guess if you will, compared to problem 8.1, but no big deal. And I think is that the only journal entry? Calculate the amount of depreciation expense. Yep. Yeah, so then it's just calculating the depreciation values for each of these. So so real quick, just the journal entry first of all. There's only going to be one journal entry, so let's get that out of the way. So as far as the journal entry goes, and I'm gonna try and find a good spot to put this. Let's put it down here just because that sort of gives us more room with the way that these cells are spread out. Okay, so let's make just a little journal entry down here. And so this was on April 1st. Okay, and we paid cash for all this stuff. I think we might need an extra row here. Let me delete this so we get move things up a little bit. So we paid the let's leave that for explanation. We paid cash. So remember, cash is an asset. Assets are credits to decrease, and we paid $400,000. And then the breakdown of these things essentially, and we can just link to, because we already wrote this out, which is kind of nice. We just link that. Oh, I think we need an extra space here. Let's insert one more. So here's just our breakdown of what we paid, or how we would book these in, each as individual assets. Remember, the land does not depreciate, so that's just something to remember. And then we'll just say, group purchase, because we bought multiple things with one, in one purchase event, essentially. So that's our journal entry on 4-1. And then later we're going to have to do depreciation and all that kind of stuff for the rest of the pieces. So let's do it here. So the thing that we're going to have to account for, though, is that we're basically doing 3 different depreciations here. So the first one is on the building. The second one is on the land improvements, and the third one's on the equipment. So we only need 2 years. So what I'm going to do is I'm going to delete the 3rd and 4th year. So the way that we want to do this without messing any of our other cells up is to highlight all the way through like this, and then delete. And you see that just shifted everything up. And that's why if you just did this and said delete, it would make things go weird down here, because those cells are above, and if everything moves up, it kind of goes crazy. And if you just deleted the whole columns, you're going to delete out some of this information. So anyway, let's select those cells there, move things up. And double declining, we only need 2 years as well. Okay. And so here's what I'm going to do at this point too. I would rather have, let's cut all these cells here, and then go to your very top one and insert cut cell. So let's just paste that in there. And I'll show you the reason why I'm doing this in 1 second. I'm just kind of reorganizing things here. And then I'm going to delete these to bring these up, because I want the journal entry just to kind of be first, and then we can deal with each of the 3. And just for the sake of making this look cleaner, I'm going to paste it over like that. Okay. So, and sorry, let's do the same thing here just to kind of clean this whole thing up. Perfect. Okay, so now we can say that's A. That was A to A. And now here is B down below. So B is going to be all about the building for the 1st and 2nd years. Okay. And so we're going to put in our specifics just for the building. So the cost was $208,000. And I'm going to redo the calculations. So it's really, we could just build this into Excel. That's great. But let's redo it ourselves so that we can practice. Okay, so salvage value is $20,000. Cost is $208,000. What else? How many years? 40-year life. So that's 480 months. We don't have a units of activity in this one at all, so let's just delete those out. And let's delete out all this down here. So we don't care about the units of activity for the building. We're just using life, time. Assume the double, okay, and we're doing double declining for this one. And so we don't really even care about straight line here. So we're going to leave that one blank and units blank. And we're just going to do double declining. And again, yeah, this is just for the building. So the beginning book value is going to be our cost paid, our pay amount paid. We don't care about salvage value for double declining, remember. Let me give a little more space on these. Okay. And then we're going to take 2 divided by 40 years. There. And we bought it on the 1st. So this is where we're going to take our portion of the year. And so January, February, and March, we did not have the building. So that was 3 months. So 9 months we did have it, 3 months we didn't. So the 9 months that we did have it, we're going to do that for that first year. So 9/12 or 75%. So then we multiply these all together. So 7,800 becomes our depreciation expense. Since it's the first year, accumulated is just the only thing we've accumulated so far is $7,800. And so our ending book value then is our cost minus accumulated depreciation. Then we take our number down to the part there again. Let's drag this formula down, and then we need to fix our formula though. We dragged it down, and then I'm adding the cell back upwards to get the same 2 divided by the life in years. This is going to be now it's not 9/12. Now it's 12/12 or 100% for the second year because it's a full year's worth of depreciation. And then I'm going to drag this formula down so that we get the beginning book value times the depreciation rate times the portion of the year. So we get 10,010. And our accumulated is now the combination of our expense this year plus last year. And then we take our beginning book value or our historical cost minus accumulated depreciation. And we end up with 190,190. That's kind of funny. Okay, so cool. So there we go. Those are our first 2 years of depreciation for the building, essentially. And we can kind of just fill this out. It's sort of redundant, I suppose, at this point. But we can do depreciation expense for those first two years. Our total, our cost, and then our total minus our cost is our costs, I should say, minus our total accumulated depreciation to date is 191. So kind of the same thing we're showing here. A little bit redundant, and we're not doing units or straight line for the first year, but it's all good. Just have it here kind of as a template to fill out. It's just kind of nice. Okay, let's look at C. So for C, we're just going to be dealing with the land improvements. So let's delete everything out and kind of start from scratch here. We don't want this. This is that was just a carryover from above. Get rid of that. Get rid of all our stuff there. Okay, so now we got kind of a fresh template, if you will. We're just doing the land improvements this time. So the cost of the land improvements then is $32,000. Salvage value for the land improvements is tells us here $4,000. So then our cost minus our salvage value is $28,000. The life is 20 years. And if we multiply that by 12, if we need the months, it's 240. Cool. Okay. So we don't care about the units of activity for the land improvements. And also we don't care about the double declining because we're just going to do the straight line method here. Okay. But I'm just going to leave this stuff just because it's our template essentially. So no big deal. Just leave it blank. But let's do the straight line method here. So we've pretty much got everything that we need. We just have to factor in the notion that we bought this thing on April 1st. So remember that if we bought it on January 1st, we would take the cost minus salvage value divided by the years. But instead, we're going to divide by the months. So if we do that, that's a per month, right? So this is cost minus salvage value divided by the total months. Means that every month of depreciation in a given year when it's in service will be $117. And in that first year, we had 9 months. So we're going to multiply that by 9. So then we get 1,050 in depreciation expense for the first year. And then we can copy this formula, paste it into the formula bar. It's going to give us the same thing, but what we want to do is say not times 9, but instead times 12. Or another way we could have said was divide by 20. But if we're doing monthly, we can just take monthly divided by 12, and that gives us the same thing. So 1,400. We had the cost of 32,000. So our cost minus our accumulated depreciation at the end of 2 years means our net book value after 2 years is 29,550. Cool. Okay, and I'm going to leave the rest of all this other stuff blank because we're just doing the straight line method there. Okay, so in D, I'm going to bring this down so we can see our data. Okay, D says, calculate the amount of depreciation on the equipment and assume units of production method. So here we're going to do that one. And we've got other information, so let's do it. Let's delete out our stuff we pulled down, copied from C, and let's fill out this table of details. So that was our what's this, equipment. So our equipment up here, 64,000. And then our salvage value, it tells us, is 8,000. It has we don't care, and honestly, in this one, so here we do want cost minus salvage value. We don't care about the life, the years at all. The total units we'll want to figure out. I'm just going to delete out where it says copies because, and if it says copies above and you want to get rid of something, you can highlight all the column where there might be this word, for example. So I'm going to find copies and replace with nothing. So basically that'll go through and strip out all the places where it says copies. So just clean it up a little bit. And maybe you'll learn a little Excel trick along the way. Okay, so we got cost, salvage value, cost minus salvage value. And we want to calculate using the units of production. So the total units that we estimate is 5,000 hours. No, that's not right. 32,000 is the total. So 32,000 machine hour life. And that means that our depreciation expense per unit then is the cost minus salvage value divided by the total units. And then in the first year we only have 2 years anyway, so we don't really need those third and fourth year, but that's fine. So in the first year we had 5,000 hours, and the second year we had 10,000. Okay. All right, we're almost done now. So then we just need to go take our depreciation expense per unit times the activity for each year. So pretty straightforward. And we end up with, that looks, I think that's right. So then we end up, with, what is that? Sorry, I just saw something on my spreadsheet that looked funny, but I think that's all good. Okay. So then, again, similar thing. I'm going to, just to be fancy, I'm going to copy these cells because this will give me the total formula and this will pull in the other formulas and stuff. and we can just paste. I think it's actually might be a little wonky, but we can fix it. So that's a good one. That we need to fix over, but then that takes the difference. And yeah, our net book value at the end of 2 years is $37,750. And again, we don't care about the life or when we bought it or anything when we're doing units of activity, because it's all based on usage. So even if you bought it on this 1 week before the end of the year, but you used it a ton, that would have an impact, right? When you're doing units of activity method. But up here with double declining and with the straight line, we do need to factor in the date of purchase, essentially, right? So I think that we're looking pretty good. What did I do? Did I fill this out? Oh, what happened? Oh, I accidentally deleted. I was just looking at that. I'm like, something seems funny. I think I deleted out the double declining portion. And whoops. Okay. Sorry. If you were following along and you deleted that out too, let's fix that. So that was 208,000 equals 2 divided by 40-year life. That's the same both times. The portion of the year in the first year is 9/12. Portion of the year in the second is 12/12. A whole year, just basically 1 year. And then we take all 3 of those multiplied together. We can drag that down so it does the same. It'll fix itself in a minute. Accumulated depreciation is the same as depreciation expense for the first year. And then we take cost minus accumulated. And then we bring the ending book value down to be the beginning. And yeah. And then our ending accumulated adds in depreciation expense. And finally, our ending book value is our cost minus our accumulated depreciation to date, or 190. Okay, so somewhere when I was copying and pasting and deleting, I accidentally deleted that out. So now we're looking pretty good. So we have the building, again, double declining takes that account of proportion of year. Straight line takes that account of proportion. We did just monthly depreciation expense and then multiplied it by 9 months. And then the units of activity, though, does not matter. So there we go. I think that's everything we got to do in the problem. Yeah. All right. Well, hopefully that was helpful, and I'll see y'all in the next video.